Without further ado, I would like to hand over to our first speaker, Andrew Harvey, Senior Economist from Nationwide Building Society. Andrew, over to you.
Morning everyone, and thank you Craig for the introduction there. This morning I'd just like to start by running through what's been happening in the wider economy and then look at the implications for our markets, for mortgage lending and for the housing market. If we start off by looking at what's been happening in terms of the picture for economic growth, as many of you be aware, the UK has struggled post-pandemic compared to a lot of neighbouring economies. And of course, we've had the impact from the tightening in monetary policy, which we've seen over the last couple of years. And this has had a big impact on households and businesses. All the bank rate increases have meant that we've seen higher borrowing costs for both households and businesses. And we've also had the political uncertainty as a result of Brexit. And the Bank of England yesterday reported that there's been a chilling impact on business investment over recent years as a result of the fallout from that. So all of those combined have led to a pretty weak picture so far as the macroeconomy is concerned. Looking at inflation, I think the good news here is we are seeing an improving picture in terms of what's happening. We are seeing easing in inflationary pressures. Lower CPI figures reported as well as lower energy prices. Nonetheless, household budgets are still under a lot of pressure, and the MPC in particular at the moment are concerned around what's happening with food prices, given how that can impact household budgets. And Bailey has warned that the markets may be getting a little bit carried away in their expectations in terms of the transition to lower inflation may not necessarily be smooth, and there is a risk that the inflation we're seeing does become persistent. So we're not out of the woods just yet on that front. One of the things which has been a big impact on the economy and what we've been seeing with prices is the labour market. This chart shows that we have seen a big gap emerge in terms of where the UK labour force is compared to where it was based on pre-pandemic trends. So you've got a gap of nearly 1 million fewer workers. These supply constraints are adding to inflationary pressure. A smaller workforce is pushing up wage bargaining, and we're still seeing significant areas of skill shortages. One of the reasons we're seeing this gap in terms of the labour market is that during the pandemic we saw older workers decide to either stop working or cut down their hours. But the big factor has really been an increase in long-term sickness, and that's been compounded by the pressures we've been seeing on the NHS and the record long waiting lists, both of which are likely to persist for some time. So it's going to be a while, I think, before labour market patterns improve. The good news is, as far as bank rates are concerned, and I say this noting what Craig said earlier, we thought we might be at the top at 5.25. Markets certainly think so. The market pricing curve currently suggests that in a year's time we could be seeing 50 to 75 basis points in terms of rate cuts, and then down potentially to 4% in a couple of years' time. As the red line on that chart shows, we're in a much better position than we were just over a year ago when we had the disastrous Truss mini budget and the fallout from that. But what Jeremy Hunt says today is going to be quite important in terms of what the monetary policy stance would look like next. There's been quite a lot of speculation around potential moves, whether we will see tax cuts, for example. There is a risk that if there is fiscal stimulus delivered, for example, if we were to see a cut in the basic rate of income tax, that will potentially add to inflationary concern because it will give households a little bit more spending power. And with the supply pressures I mentioned, there is a chance that will then lead into inflationary pressures rebuilding. So the MPC are going to be likely very conscious as to what's happening there. So it's a careful balancing act. So while you may have been given on one hand in terms of tax cuts, we could see rates persisting for longer if those prove to be inflationary. So really important to watch. In terms of the outlook for growth, as I mentioned earlier, the UK economy has been stagnating for some period, and it's likely that it's going to continue to do so over the next few years, with the Bank of England's assessment that economic growth is likely to remain for some time. So what are the implications for unemployment from this? So the Bank of England are currently expecting a modest rise in unemployment, as you can see from the red line on the fan chart there. But there is quite a big range of uncertainty around this. But I think at the moment we've been probably pleasantly surprised by what's been happening in the labour market. It has been more robust than we might have expected. And even in the forecast, unemployment will be quite low by historic standards. Again, that's good news so far as mortgages are concerned in terms of arrears at the moment, still relatively low. And of course, a number of measures in place in terms of lender forbearance, which are keeping borrowers from facing possession, for example. In terms of the outlook for inflation, inflation is expected to moderate and return to target over the next few years, but it is important to emphasise there is a significant level of uncertainty around this, and it might not necessarily be a smooth transition. As I mentioned earlier, the Bank of England have highlighted the concerns around food prices, and that these will tend to be linked to inflation expectations and hence feed into wage bargaining. We've also seen, of course, the ongoing conflicts in Ukraine and Middle East. And again, that creates upside risks so far as energy prices are concerned and the cost of food production. So again, the trend is certainly improving, but there is still a lot of uncertainty as around how it will develop going forward. So what does all this mean for our markets? So clearly the big story in recent years has been what's been happening with mortgage pricing and the impact that's had on activity. As you can see here, obviously we've seen a significant rise in swaps since 2021, and that in turn has led to higher levels of pricing for fixed rate mortgages, which of course the vast majority of mortgages tend to be on. There are signs that things are starting to improve. We have certainly seen some lenders bring down their rates more recently, but of course they do remain pretty high relative to where we were a couple of years ago. The obvious implication for this is on affordability, especially for prospective first-time buyers. What we're looking at here is our benchmark measure, which is an 80% LTV mortgage for a typical first-time buyer, and what their mortgage payments look like for that, given today's mortgage rates. So at the moment, first-time buyer mortgage payments would be around 38% of their take-home pay, and that's well above their long-run average of just under 30%. So clearly that's acting as a significant headwind so far as activity is concerned, coupled with the challenges of raising a deposit, with deposits still being very high relative to earnings at the moment. So you've got this sort of a double whammy pressure of trying to raise a deposit and also higher levels of mortgage payments. This is particularly true for those who are in the private rental market, where we've seen rental demand continue to outstrip supply, and that's led to significant upward pressure on rents. Renters already spend a relatively high proportion of their income on housing costs, so this means it's particularly challenging for those who are looking to raise a deposit in order to do so, with very little disposable income left to save for a deposit. Given these pressures, it's not surprising that housing market activity is relatively subdued. So the most recent data from the Bank of England has got approvals just over 43,000 a month, and that's around 30% below where we were in 2019. But the pattern activity hasn't been the same across all sectors. I'm moving on here to look at completions as opposed to approvals, but I think the story is still quite relevant. The biggest declines we've seen so far this year have been amongst buy-to-let purchasers who are involving a mortgage. The current rate environment, of course, means it's extremely challenging in terms of the economics for new purchase. So we've seen a big decline in activity there. Home mover activity also down quite strongly at the moment. Again, there may be an element that home mover activity tends to be a little bit more discretionary. So given the rate environment, there are fewer home movers choosing to do so. So far as first-time buyers are concerned, a little bit better news here. Those have been a little bit more resilient given those affordability pressures. But the bit which really stands out for me is on the right-hand side of the chart there, which is cash transactions, which are actually above where they were pre-pandemic levels. And of course, this is a reflection that those who are buying with cash are not facing the same impact from the higher rate environment. As I mentioned, first-time buyer activity has held up reasonably well, and that's despite the winding down of Help to Buy equity loan, which obviously has been something which is very relevant for all you guys in terms of the new build sector. What we've seen over recent years is a decline in terms of how much first-time buyer activity has been delivered through the scheme. So the market has found its sort of own solutions, if you like, to that. And it's also the case that in terms of the importance of Help to Buy to new build developers, that's also diminished certainly over recent years as the scheme has narrowed in scope and been wound down. So we were at a point where over 40% of private new build completions were being snapped up through Help to Buy equity loan. It's down below 20% now. We've also seen a shift in the types of property being purchased. Now, an element of this may well be connected to Help to Buy in terms of, as the scheme narrowed, in terms of the regional price caps being brought in, we've seen a sort of shift away from detached properties, which had tended to dominate the earlier phases of the scheme. But there's also a chance that this is related to the affordability pressures I outlined earlier. So the biggest declines have been for those who are purchasing detached houses. This is true for first-time buyers and for home movers. And we've seen smaller declines in terms of transactions for properties which perhaps at the cheaper end of the spectrum, so terrace houses and flats, for example. This is also aligned with what we've been seeing with house pricing in these. So it's detached properties which have seen the biggest growth. This is looking at prices from just before the start of the pandemic to where they are currently. It's detached where prices have increased by the most and flats by the least. Now, a lot of this, I suspect, is due to the shift we saw during the pandemic in terms of preferences, people looking for more space, for example. We saw a lot of home mover activity stimulated by people wanting home offices, perhaps moving out away from city locations to more rural locations. Some of those trends are now diminished, but certainly in terms of the impact on price, it has been quite lasting. We've seen relatively weaker prices for flats. Again, some of this will reflect that during the pandemic, demand for flats fell significantly and the price growth was a lot weaker. Moving on to what's been happening with house prices more generally. Housing market prices have actually been relatively resilient given all those pressures we have been seeing. Prices down around 3.5% year on year at the moment. Interesting point to note here is that pricing amongst new build property has actually held up better. So since the start of the pandemic, prices in new build have increased by 23% compared to 19% for properties overall. Households are in relatively good shape in terms of their balance sheets, and also labour market conditions have been quite strong. So what this chart here is showing is what's been happening with those who are rolling off existing fixed rates. As has been widely reported, there's quite a high element of rate shock involved because, of course, the rates we were seeing a few years ago were much lower than those currently on offer. The good news here, I think, is that the affordability testing and the lending standards which were in place during that time have helped ensure that most borrowers are able to afford the repayments. And of course, there are options there for those who may need additional assistance. We've got the mortgage charter measures now in place as well, for example. Another element households have got in terms of being able to address those challenges is their deposits. And what we've seen is a significant build-up in terms of excess deposits, if you like, compared to where we were previously. An element of this was forced savings, which happened during when parts of the economy were shut down due to COVID restrictions. But we've also seen households continuing to save, actually, in more recent times, thanks to the stronger rates on offer. We've also seen amongst that sort of certain providers, for example, National Savings and Investments have been very competitive and attracted a significant level of inflows in recent months. The picture of savings is a little bit complicated because there is this big excess of savings, but it doesn't generally get held sort of evenly. So it has tended to be households who are perhaps a little bit older, a little bit wealthier, who tend to accumulate the highest deposits. There's quite a lot to look at on this chart, but the main point to take away is that it's households which own outright, so don't have a mortgage, which do tend to be typically older households, tend to have a lot more in savings than those who have a mortgage, and certainly a lot more than those who are in the private rental sector. So the solid blue bar and the dark blue at the end there, you can see amongst those who own outright, around 25% have got more than 100,000 in savings. At the other end of the spectrum, there's a surprisingly high proportion of those with a mortgage who have relatively little savings. So you can see in terms of the middle bars there, those who've got a mortgage, about 30% or so have sort of less than 2,000 in savings. So not much of a safety net so far as those are concerned. For those in the private rental market, it's even worse in terms of that's the light blue bars on there, where around 30% don't actually have any savings at all, which is a little bit concerning in terms of their ability to pay should they lose their job, for example. And on a related point, our research using the labour force survey data suggests that those in the private rental market are actually potentially more susceptible to unemployment. What we've looked at here are the trends in unemployment following the financial crisis. As you can see, those in the private rental market and also social renters, so that's housing association and local authority, saw relatively larger increases in unemployment compared with those who had a mortgage. And this is just showing the same sort of data, but over time you can see unemployment rate is typically a little bit higher for those in the PRS. That gap has narrowed. Some indication that it may have started to widen again. Perhaps take a bit of a pinch of salt, given there are currently issues with some of the data for the labour force survey, but there's certainly something to keep an eye on in terms of what's going on there. There are some encouraging signs for UK households. It's not all doom and gloom. If we look at what's been happening with private wage growth, what we've seen is wage growth has been relatively strong. Inflation has started to come down, so it means actually wages are now growing in real terms. But it is important to be realistic about sort of near-term prospects, given where we are with rates at the moment and how much they've risen and the time it's going to take for the affordability picture to improve. And what we have been seeing in terms of mortgage activity is activity certainly for house purchase and remortgage has both been relatively subdued at the moment, and our current expectation is this is likely to remain the case over the next year or so. Our general story really is that we are expecting a soft landing in the housing market, and we are expecting sort of modest levels of house price falls, and we're expecting earnings growth to continue to exceed house price growth. So coupled with interest rates starting to come down over the next couple of years, that will mean affordability will gradually start to improve, but it's likely to be quite a drawn-out process. So our expectation is that housing market activity will remain relatively subdued over the next year or so. Finally, with something sort of coming up over the next within the next year is the general election. We've had a quick look at what's happened with housing market activity and also house prices in previous elections. Elections don't appear to have a significant impact in terms of what happens with activity. This one's around mortgage approvals. There's no discernible pattern in terms of the picture there. Clearly, voters will be looking to see what types of policies a new government have in place. As Craig mentioned earlier, we've had a very long succession of housing ministers in recent years. I suspect as a sector we'll be certainly looking for more stability from a future government. Labour's plans for the housing market seem relatively ambitious in terms of what they've set out, in terms of building 1.5 million homes in the first 5 years. So that's sort of delivering 300,000 homes a year, which is something we haven't done in a long time. Whether it can be done is another matter, but it's certainly something we'll be looking for as a sector to see perhaps a more fully rounded housing market policy with more stability in terms of policy making as well. And to look at what's been happening with house prices, again, a similar picture here in terms of we don't generally see a trend, the trend in house prices change significantly sort of around elections. It pretty much carries on what it would be doing otherwise. So that's sort of where I wanted to conclude, really. Obviously, we'll be looking forward to today's autumn statement to see what developments it brings. I'm not necessarily expecting anything significant in terms of the housing market. Clearly, we already have a stamp duty in place for some buyers at the moment. It's possible that could be extended, but we'll be looking to see what happens with levels of personal taxation as well, and that important trade-off between fiscal and monetary policy. So thank you all for your time.